Hello friends, welcome back to the classes on partnership, the fundamentals. In this session, we will learn about the methods of maintaining the capital accounts for partners. This is the third session for this chapter. I hope you have gone through the first two sessions which are already there on the YouTube. Now, but before we start this session, as always, I would like to start with a quick recap from the previous one. We learnt about making the profit appropriation account in the last session. I introduced you to the 4-box approach, wherein we got outputs from each box that helped in making the appropriation account without making mistakes. From box 1, we got the total profit that's available to the partners for appropriation. From box 2, we calculated the total appropriations required by the partner. In box 3, we compared the results from the first two boxes to see if the profit available for appropriation was adequate to meet the appropriations. This helped us in determining the profit sharing ratio which will be used to distribute the profits. Then the box 4 was the profit appropriation account itself. We spoke about the 3 scenarios that could arise in the process and the sharing ratio that will be applicable in each of these scenarios. The scenarios were when profit for appropriation is more than total appropriations, when profit for appropriations is less than total appropriations, and third one is when the firm is in loss. Now let us start with today's session, the accounting methods to maintain capital accounts of the partners. Hi, this is Amit Lawania welcoming you to study and learn the concepts of accountancy. Capital is the amount invested by the partners into the firm. This could be in the form of cash, a bank account, a check, or any asset that is used by the firm for its business purposes or activities. Now, the capital accounts show us this amount, which is the amount invested by the owners of the firm. There are two methods to maintain the capital accounts by a firm. First one, the fixed capital account method, and second, the fluctuating capital accounts method. Now, as the name suggests, the basic difference between the two methods is that in fixed capital account method, which is the first one I mentioned, the amount of capital does not change. In this method, a separate account, which is called current account, is maintained for each partner, and all the transactions are recorded in that account. So all the changes take place in the current account, and the capital account generally remains constant. On the other hand, in fluctuating capital accounts, all the transactions are recorded in the capital accounts of the partners. Now, to further understand, let us have a look at the differences in the two methods. First, why are these methods followed? Fixed capital method is followed to show the original amounts invested in the firm without taking into account the daily transactions that occur during the year. Whereas fluctuating capital method is undertaken to show the invested amounts by partners in real time. What kind of accounts are maintained under the two methods? Under fixed capital method, two accounts are maintained, that is partners capital and partners current accounts. In fluctuating capital method, only the capital account of the partner is made. Where do the entries go? In fixed capital method, all the entries during the year are recorded in the current account. Whereas in fluctuating method, each transaction is adjusted to the capital account of the partner. How does the capital account behave? In fixed capital method, the balance of the capital account remains fixed, except in some extraordinary cases. While in fluctuating capital method, the balance in capital account fluctuates with every transaction. What about the current accounts? How do they behave under the two methods? Under fixed capital method, each transaction is entered into the current account. So the amount keeps fluctuating. And in the fluctuating capital method, the current account is not even made, because all the transactions are recorded in the capital account itself. I hope the two methods are now clear in your minds. Let's use an example to clear the concepts further. I am providing a case or a question here. Please note it down so that you can refer to it when I provide the answer. Here we go. X, Y and Z are partners in a firm sharing profits in the ratio of 2:1. So we have the profit sharing ratio. They have opening capitals of rupees 50,000, rupees 40,000 and rupees 20,000 respectively on 1st April 2018. X withdrew rupees 5,000, Y withdrew rupees 3,000 and Z withdrew rupees 2,000 from the firm. So we get the amount of drawings also. Agreement allowed 5% per annum interest on capital and 10% per annum interest on drawings. Profit and loss account shows a profit of rupees 15,000. You have to pass the journal entries and prepare the capital accounts in fixed and fluctuating methods as on 31st March 2019. Now I have made a small table and noted all the numbers given in the question so that they are easy to comprehend when we pass the journal entries and make the ledger accounts. Pause the video if you need more time to note down the question or the table. Now in my last sessions I have not touched upon the concept of journal entries, which I will do now, but I believe that you have learned the same in 11th standard, so you must be aware of it. Here is the format. I hope you remember this. Columns for date, particulars, ledger folio, debit and credit. Even if you don't remember this, you can just note it down from here. It's very easy. Now we can go ahead with passing the entries. First, we see drawings made by the partners and record them as a journal entry. X's drawings account debit, Y's drawing account debit, Z's drawing account debit to cash account, and the amount is given as 5,000 for X, 3,000 for Y and 2,000 for Z. These are the amounts that they have withdrawn from the firm. It's given in the question, and we assume that these drawings have been made in cash, that is, they have withdrawn cash from the partnership firm. So we credit the cash account and the total cash withdrawn is 10,000 rupees by the three partners. The with amounts withdrawn by each partner I mentioned in the debit column, whereas in the credit column we mentioned the total amount which is withdrawn. You will notice that there is no date given for this entry. That is because it is not given in the question also. We do not know if these drawings have been made on a single date or have been made over a period of time. If you like, you can make an entry in the dates column as the last date of the year, which is 31st March. Now for the next entry, we start with the date and transfer the amount of drawings to the partner's account. For partner X, the amount of drawing was rupees 5,000. Then we write the narration. Never forget to start with the date and end with the narration. Now we pass the same entry for partner Y and for partner Z. Now we head to the appropriation of profit by first transferring the profit from profit and loss account to the profit appropriation account, and the amount is given in the question as 15,000 rupees. Do not forget the narration. Again, we write the date first and start passing journal entries for appropriations to be made for the partners, starting with the interest on capital. So the entry is profit appropriation account, debit to interest on capital account. This is the total interest payable to all three partners combined, amounting to rupees 5,500, and the narration in the end. Continuing the journal entries, interest on drawings is now transferred to the profit appropriation account. Entry will be interest on drawings, debit to profit appropriation account, and the amount will be rupees 500, which is the total amount of interest on drawings for all three partners combined. Now, as all the appropriation entries have been made into the profit appropriation account, we had two clauses. One was for interest on capital and the second was on interest on drawings. We have entered both. So now we will start transferring these clauses to the partners' accounts. In this case, it is the capital accounts because we are following the fluctuating capital accounting method. First, we distribute the adjustment for interest on capital totaling to rupees 5,500, which we put in the debit side, and we transfer it to the capital accounts of X, Y and Z, mentioning amounts separately, that is rupees 2,500 for X, 2,000 for Y and 1,000 for Z, and write down the narration last. Now similarly, we transfer the second clause, that is interest on drawings, to the partners' capital accounts. Here the capital accounts are debited. X's capital account with 250 rupees, Y's capital account with 150 rupees, Z's capital account with 100 rupees, and total interest on drawings being rupees 500. You can see on the top of the table here on this page, interest on drawings of 500 was debited. So we cancel out that entry, we balance that entry by transferring this interest on drawings to the capital accounts. We now transfer the profit after adjusting the interest on capital and drawings to the partners, that is rupees 10,000. I haven't made a profit appropriation account here. I would like you to make one and see how I got to this figure of rupees 10,000. It's not difficult, it's very easy. I recommend that you make it for practice. Well, anyways, distributing this profit of 10,000 in the ratio of 2:2:1 for X, Y and Z with the narration. Here I would like to mention that except the profit that we bring down to the profit appropriation account, except that one entry, all the other entries in the profit appropriation account have to be transferred to the partners' accounts. It could be a capital account or current account as per the case, but please make sure that all the transactions from profit appropriation account are transferred to the partners. Now, having made the journal entries, We will now make the capital accounts for each partner. The format remains the same as any ledger account, only that I am presenting all the capital accounts together. If you have time during the exam, you may present these accounts separately. We start with the balances brought down as on 1st April, 50,000 rupees for X, 40,000 rupees for Y, and 20,000 rupees for Z. Next, we credit the interest on capital receivable by the partners from their firm at rupees 2,500 for X, 2,000 for Y, and 1,000 for Z. Now, the distributable profit from the profit appropriation account is now credited to the partners account. Rupees 4,000 for X, rupees 4,000 for Y, and rupees 2,000 for Z in the ratio of 2:2:1. That is given in the question itself. Coming to the debit side, we put the entry for drawings made by partners. This reduces their invested amount in the firm because they withdrawn the amount. Also, the interest on drawings is mentioned on the debit side. This is the amount that is payable by the partners to the firm. Now, when all the entries have been made, we calculate the totals. Credit side first, as it is greater, with total of 56,500 for X, rupees 46,000 for Y, and rupees 23,000 for Z. We write down the same totals on the debit side. Next, we calculate the balance amount for debit side, which is the difference between total of debit entries and the grand total that we have brought from the credit side. That comes out to be rupees 51,250 for X, 42,850 for Y, and 20,900 for Z. These amounts will then become the opening capital for the next financial year of the firm and for the partners. Now we will see how the entries are made when fixed capital account method is followed. Now, in case of fluctuating capital account method that we just studied, the accounting entries were made into the capital accounts of the partner. But in fixed capital account, now we will maintain one more account where all the entries will be made. This will be the current account, and no entries will be made into the capital account. We have already discussed this earlier today. Now it is time to understand the concept with the help of our example. Now, taking the same question that we used for fluctuating capital method, we will now check the entries that were made to the capital accounts. For the first entry, capital accounts are not involved, so this entry will remain the same. In the second journal entry, we see that X's capital account is debited with the amount of drawings. But in fixed capital account method, the entry will change. We do not touch the capital account in this method. Instead, we note it into the current account. So it will be X's current account debit to X's drawings account. The amount remains same, which is rupees 50,000. Similarly, the entry towards Y's capital account will be changed to Y's current account. And next, the entry for Z's capital account will be changed and converted into the Z's current account. Next two entries do not involve capital accounts, so they remain the same, just like they were earlier. Now, turning on to page 2, we find that the first entry does not involve the capital accounts of partners. So we do not change anything there. But in the second entry, we will have to change the entries from capital accounts of the partners to the current accounts of X, Y, and Z. So the interest on capital is now transferred to the current accounts. Also, we see in the narration it is mentioned that the amount of interest on capital is transferred to partners' capital accounts. So we need to change it and make it partners' current account instead. Similarly, in next entry, we will replace the capital accounts to each partners and capital accounts to the current accounts of each partner, and change the narration accordingly. Now, do the profits go to capital accounts? No, they don't. Even the profits are sent to the partners' current accounts. So we change this entry and the narration. Now let us take a look at how the entries will be shown in the ledger accounts. As we already know, there are two accounts maintained in fixed capital account method. So we prepare the current account for each partner. The format remains same as any other ledger account, starting with the balance brought down. But no amount is given in the question, so we write 0 for each partner. Next, we start passing all the entries from the profit appropriation account and given in the question for each partner. First is the interest on capital being credited to the current accounts this time. Then the distributed profit from the profit appropriation account, again going to the current accounts. The drawings are entered on the debit side just as they were done for the capital account in the earlier method, but this time they are shown in the current account and the interest on drawings as well. Now we see all the entries relating to the partners and those entries which were there in profit appropriation account have been entered into the current accounts. So we write down the totals. Credit side again being creditor, we start with the totals on credit side, 6,500 for X, 6,000 for Y, and 3,000 for Z. And we copy the totals on the debit side. Next, we find the balance amount for the debit side for each partner, 1250 for X, 2850 for Y, and 900 for Z. Now can you tell me where these accounts will show in the accounts book? They will be shown in the balance sheet as partners' current accounts, just like we show the capital accounts of each partner. How would the capital accounts look like? Remember well that no entries are made in the capital accounts in this method. So the opening balance remains the closing balance. The method followed is fixed capital method, and accordingly the amounts in the capital accounts remain fixed. Before I end the session, a quick recap should help in keeping your minds uncluttered. For maintaining the capital accounts of the partners, there are two methods. Fluctuating capital account method, where all entries are made into the capital accounts of the partners, and fixed capital accounts method, where we maintain an additional account, that is the current account, and all the entries are made into this current account. Capital account in most cases remain untouched and hence fixed. I would like to remind you how the capital accounts of the partners are related to the profit appropriation account. Please remember that except the profit brought down from P&L account, which is the first entry in profit appropriation account, except that entry, all the other entries from the profit appropriation account should be shown in partners' accounts, which could be a current account or capital account as per the case. Do recheck this when you're attending the exams. Make sure all the entries are transferred to the partners from profit appropriation account to the partner's capital or current account. Do not miss any entry of appropriation to partners from the profit appropriation account. So friends, this will be the end of this session. I hope you found the same interesting and helpful. This is Amit Lawania saying goodbye. If you wish to join my classes in Delhi, feel free to contact me for details. Goodbye for now. I suggest you that you find new questions, keep practicing them. I leave you with one now. Practice makes 100 out of 100. The perfect.